Everyone wants to get rich fast. They want the story, the trade that 10x'd overnight, the crypto buy that turned $1,000 into $1 million. Social media is flooded with screenshots, celebrating people who hit it big in a single move. But here is what nobody talks about. Most of those stories end quietly and badly. The real wealth, the kind that lasts generations, was never built in the flashiest corner of the market. It was built slowly, steadily, and honestly in the most boring places imaginable. The exciting stuff gets the headlines. The boring stuff gets the results. And that gap between the two is exactly where most people lose. The illusion of exciting investing. There is something deeply human about chasing excitement. When a new trend explodes, whether it is memes, stocks, NFTs, or the latest AI-powered startup, it feels irresponsible not to jump in. The brain registers it as opportunity. The fear of missing out becomes louder than the voice of reason. This is how most retail investors operate. They buy when the buzz is at its peak and sell when fear sets in. They react to every headline, every dip, every surge. And the data is not kind to that behavior. Studies consistently show that the average retail investor earns returns several percentage points lower than the broader market over a 20-year period. The market itself does fine. The investor, chasing the excitement of it, does not. Think about the meme stock frenzy of early 2021. GameStop, AMC, stocks that had no business trading at those levels suddenly became cultural phenomena. Millions of people poured money in. A handful got out at the right time and made life-changing profits. The majority held too long, chased the wrong peaks, and watched those gains evaporate just as fast as they appeared. The excitement was real. The wealth, for most, was not. Or take the crypto boom and bust cycle. Bitcoin hit nearly 69,000 in late 2021. Celebrities promoted it. Regular people mortgaged their futures to buy in at the top. By 2022, it had collapsed by more than 70%. The people who got hurt most were not the seasoned traders with exit strategies. They were the everyday investors who believed the hype and trusted the noise over a plan. The financial media feeds this machine deliberately. Volatility creates viewers. Dramatic market swings keep people glued to their screens. But the more attention someone pays to short-term noise, the worse their long-term results tend to be. Drama costs money. Excitement is expensive. And this is exactly the trap that boring markets help people avoid. Why boring markets actually win? Here is the uncomfortable truth about wealth it accumulates in silence. Warren Buffett is the clearest example in the history of investing. He still lives in the same house in Omaha, Nebraska, that he bought in 1958. He drives himself to work. He eats at McDonald's. His wealth, which has grown to over $100 billion, was not built by chasing the hottest sectors or timing market cycles. It was built by buying great companies at fair prices and holding them for decades. He famously called index funds the best investment for most people. Not because they are thrilling, but because they work. Buffett has stated openly that his favorite holding period is forever. That single philosophy, applied consistently over decades, is what turned him into one of the wealthiest people on the planet. Not a hot tip, not a perfectly timed trade, just patience and discipline applied to boring, reliable businesses. There is also the remarkable story of Ronald Read, a janitor from Vermont who worked at a gas station and later at JCPenney. He never earned a high income. He never made a single dramatic investment move. But when he passed away in 2014 at the age of 92, his estate was worth over $8 million. He had quietly spent decades buying blue-chip stocks and dividend-paying companies and simply holding them. He reinvested the dividends. He never sold in a panic. He never chased a trend. He let time do the work. That is what boring markets do. They let compounding operate without interference. Dividend-paying stocks, for instance, are the definition of unexciting. They do not make headlines. They do not have viral moments. But historically, dividends have accounted for nearly 40% of the S&P 500's total return over long periods. Companies that have paid and increased dividends for 25 consecutive years or more, often called dividend aristocrats, have consistently outperformed the broader market during downturns. In every single year the S&P 500 finished negative since 1989. These reliable, quiet stocks beat the broader index by an average of more than 13 percentage points. Index funds tell the same story. When Jack Bogle launched the first index mutual fund through Vanguard in 1976, Wall Street laughed at him. The idea of simply owning everything and doing nothing seemed absurd to professionals who believed in the power of active stock picking. But decades later, data proved Bogle right. Between 80 and 90% of professional fund managers fail to outperform the market consistently. An investor who put 100,000 into a simple global index portfolio in 1972 and have approximately 39 million today, no trading, no strategy sessions, no stress, just a boring, systematic commitment to staying invested. The mathematics of compounding rewards patience more than it rewards brilliance. A portfolio growing at 10% annually doubles roughly every 7 years. An investor who contributes 100 per month to an S&P 500 index fund over 30 years, despite only contributing 36,000 in total, could end up with over 280,000. That kind of result does not come from excitement. It comes from repetition. How to build wealth the boring way. Understanding this is one thing. Actually living it is another. The reason most people fail to stick with boring strategies is psychological. The brain craves stimulation. Flat periods in the market feel like failure. Watching a neighbor brag about a winning stock trade is deeply uncomfortable when a portfolio has been sitting quietly for months without dramatic movement. Social media makes it worse. Every platform is algorithmically designed to surface the most extreme stories, the biggest wins, the wildest predictions, the most chaotic market moments. To build wealth the boring way, the mind has to be trained to measure success differently. Progress is not a daily event. It is an annual, decade-long story. Checking a portfolio every day is not discipline. It is anxiety disguised as attention. The investors who check their accounts the least often tend to outperform those who check them the most, because they make fewer emotional decisions. Mark Zuckerberg, despite being one of the wealthiest people alive, still takes out mortgages on his properties rather than buying outright with cash. That is not because he needs the money. It is because he understands the value of liquidity, leverage, and keeping capital working in smarter, structured ways. Wealth at every level rewards structure over impulse. The boring strategy looks like this in practice. It means maxing out retirement accounts first before doing anything else. It means consistently contributing to diversified index funds on a fixed schedule, regardless of what the market is doing. It means reinvesting dividends automatically rather than spending them. It means owning a home and building equity over time through consistent mortgage payments. And it means leaving that money alone long enough for compounding to work its quiet miracle. None of those steps are exciting. None of them will generate a viral post or a social media brag. But applied consistently over 20 or 30 years, they create something that hot trades almost never do: lasting, reliable, generational wealth. The markets that look the most boring are often the most resilient. They survive crashes. They recover from recessions. They do not rely on hype cycles or celebrity endorsements to hold their value. They just keep doing what they have always done, growing steadily, paying dividends, and rewarding the investors patient enough to stay. There will always be a new exciting trade. There will always be a trending asset that promises everything. And there will always be someone posting about how they struck it rich overnight. But for every one of those stories, there are thousands of quiet investors, people no one talks about, who are steadily, methodically, and boringly building the kind of wealth that actually lasts. The market rewards patience. Time rewards discipline, and the most powerful financial decision a person can make is choosing to be incredibly, deliberately, unapologetically boring.